Everyone thinks bank failures are about fraud. Penn Square proved something worse. They were about momentum. In 1973, Penn Square Bank was a mid-sized lender in Oklahoma City. Nothing remarkable. But the men running it, Chairman Beep Jennings, President Bill Jennings, and loan officer Bill Patterson, made a calculated bet that would reshape American finance. Oil prices were climbing. The energy sector was booming. They decided to corner the market on one thing: lending money to oil and gas wildcatters who'd never borrowed at scale before. By 1978, they weren't just lending to oil men. They were aggressively courting energy brokers, middlemen who packaged oil loans into bundles and sold them to bigger banks. The strategy was simple. Penn Square would originate the loans, collect fees up front, then pass the risk downstream. They knew what they were doing, they just didn't know what would happen next. The numbers tell the story. In 1976, Penn Square's oil and gas loans totaled roughly $47 million. By 1980, that figure had exploded to over $2 billion. That's a 40-fold increase in 4 years. The bank's total assets ballooned from $300 million to $500 million. Regulators noticed, but energy was the future, wasn't it? No one wanted to be the pessimist calling a boom a bubble. The problem wasn't just growth, it was recklessness. Penn Square was lending to operators with minimal geological data, unproven reserves, and shaky balance sheets. They'd sometimes approve $10 million loans based on a handshake and a promise. Internal credit reviews often skipped, collateral verification loose at best. The bank was betting not on oil reserves, it was betting on oil prices staying above $40 a barrel forever. But here's what Penn Square's executives didn't know in 1980. The price of oil would collapse. They couldn't see it coming. OPEC was fracturing, inflation was cooling, global oil supplies were rising. By June 1981, West Texas Intermediate crude was still holding steady around $40. By December 1981, it had cracked $35. By 1982, it was headed toward $30. Then lower, the bet was about to blow up. By mid-1982, Penn Square's borrowers couldn't pay. Wildcatters went bankrupt by the dozens. Wells that should have generated cash were hemorrhaging money. The bank's loan portfolio, once a crown jewel, was now a catastrophe. Somewhere around June 1982, internal auditors at Penn Square finally admitted what management had been avoiding. The oil loans were collapsing, losses were mounting, the bank was insolvent. On June 5, 1982, federal regulators closed Penn Square Bank. It was the largest bank failure since the Great Depression. The bank held $517 million in deposits, most of them uninsured beyond the FDIC limit of $100,000. Customers lost tens of millions. But the real damage was just beginning. You see, Penn Square hadn't just made bad loans. It had sold those bad loans to correspondent banks, larger institutions that trusted Penn Square's judgment. Continental Illinois National Bank in Chicago had bought over $1 billion in Penn Square loans. Seafirst Bank in Seattle held $430 million. Northern Trust in Chicago, Chase Manhattan in New York, and dozens of regional banks had all loaded up on energy debt. When Penn Square failed, the exposure spread like wildfire. By July 1982, Continental Illinois was reporting massive loan losses. By August, rumors were circulating. By September, large depositors started withdrawing cash, not in small amounts, but in hundreds of millions. Panic spread through the interbank lending market. If Continental failed, the dominoes would fall nationwide. The Federal Reserve stepped in, eventually engineering a rescue, but the damage to confidence was done. By the end of 1982, over 40 American banks had failed or required emergency assistance. The total cost to the FDIC, nearly $3 billion in that year alone. The broader economic damage, loan contractions, credit freezes, reduced investment, rippled through the entire economy. A regional oil bust had become a national banking crisis. One bad bet, multiplied across a network of correspondent relationships, had nearly broken the system. What's critical to understand is this: Penn Square's executives made their decisions under pressure with information available at the time. They saw oil booming, they saw competitors growing faster, they felt the weight of quarterly targets. But they failed to ask a simple question: what happens if I'm wrong? What if oil prices fall? They had the data to calculate that risk. They chose not to. The Penn Square collapse taught the banking system a painful lesson. Concentration risk is invisible until it explodes. When one lender dominates a single sector and then sells that concentration to other institutions, you've created a chain reaction waiting to happen. Regulators learned it, banks learned it, but the lesson had to be written in billions of dollars of losses and hundreds of failed institutions. Today, when you hear about stress tests or concentration limits on bank portfolios, you're hearing the echo of Penn Square. When regulators scrutinize sector-specific lending, they are remembering 1982. The system is safer now, not because we've eliminated risk, but because we've learned what happens when smart people make bold bets without asking hard questions. Subscribe to explore more financial collapses where ambition, pressure, and incomplete information collided, and see what the system learned or didn't. Subscribe to explore more financial collapses where ambition, pressure, and incomplete information collided, and see what the system learned or didn't.